Today, we're doing a full definitive review of the multi-member LLC profit distribution system. Now, think of this like a high-performance engine for your business. It's incredibly powerful for sure, but it also comes with some very real risks. We're going to break down its features, put its performance to the test, and give you the hard data you need to decide if it's the right tool for you.
And this really gets to the core of it, right? This is the one challenge every single multi-member LLC owner is up against. The system gives you this amazing flexibility in how you share profits, but that exact same freedom is what can put you directly under the IRS microscope. So the big question is, can you actually get all that flexibility without the audit risk? Let's find out.
This video contains affiliate links. Before we dive into the exact formulas for distributing profits and keeping the IRS off your back, let's talk about the foundation. You absolutely cannot pay out your partners safely without a properly structured multi-member LLC and a rock-solid operating agreement. Most business partners try to handshake their profit splits as a general partnership or cut corners on their initial state filings, and that's exactly why they trigger massive audits or end up in bitter lawsuits over the money. Your partnership needs to be a legitimate, legally separated entity with crystal clear ownership percentages on paper. That's where Busy comes in. Busy is the absolute best service out there for co-founders, handling your entire LLC formation plus state fees. They take care of the heavy lifting for you, filing your articles of organization, providing your legally required registered agent service, securing your multi-member EIN, which you absolutely must have, to file your 1,065 partnership tax returns, and setting up your compliance alerts. Most importantly, they give you the framework to establish a customized operating agreement so every single profit distribution is documented, legal, and audit-proof. This is non-negotiable if you want to scale with partners and protect your personal wealth. I've put a special link in the description below. Use my link to get your multi-member LLC set up right through Busy today and unlock some exclusive discounts and perks. Get that legal foundation handled first, and then let's get those profits distributed.
In this first section, we are breaking down the absolute fundamental, moving parts of how profits get shared in a multi-member LLC. So first things first, what are we actually reviewing here? Well, a multi-member LLC is essentially a hybrid. On one hand, it gives you the liability protection of a corporation, which is great. It shields your personal assets. But for taxes, it acts like a partnership. Profits just pass through directly to the members' personal tax returns. This simple idea is the foundation for this whole system. Okay, this right here is a critical point that trips up so many business owners. There's allocation, and then there's distribution. They are not the same thing. Allocation is just the on-paper split. You know, if the LLC makes 100 grand and your allocation is 60%, you're owed $60,000. A distribution, on the other hand, is the actual cash you take out. You might only take a $30,000 distribution and leave the rest in the company. See the difference? What you're owed versus what you're actually paid. All right, let's move on to the next section, the core features and specs. This is where we look at the specific tools, rules, and all the options you have at your disposal when you're using this LLC payout system. The entire system, and I mean all of it, runs on one absolutely critical piece of hardware, the operating agreement. And look, this isn't just some formality or a piece of paper you sign and forget. It is your user manual. It's your primary defense if you get audited. If you don't have one, the state's default rules usually kick in, which often means profits are just split equally, no matter who did what. So the system gives you two main ways to get paid. First, you've got an owner's draw. Think of this as a profit distribution. Its main advantage, and it's a big one, is that it's not subject to self-employment taxes. The other option is a guaranteed payment. This is more like a salary you get for the specific work you do, like managing things day to day. It gets paid out no matter what, even if there's no profit, but it is subject to self-employment taxes. Choosing between these two is a huge strategic decision.
And now for the advanced feature, the thing that gives the LLC its legendary flexibility, special allocations. This lets you split up the profits in a way that has nothing to do with ownership percentages. So for example, you could give a much bigger share of the profits to the member who put up most of the startup cash. It is an incredibly powerful tool.
But, and this is a big but, that power comes with a major warning label from the IRS. It's called the Substantial Economic Effect Test. The IRS looks at these special allocations really closely to make sure you're not just playing games to avoid taxes, like shifting profits to a low-income partner just to lower the group's tax bill. The deal has to have real economic substance. If you fail this test, the IRS will just ignore your agreement completely and tax everyone based on their ownership percentage. End of story.
So, we've seen the features on paper. Now, how does this whole system actually perform under pressure? Let's see how it holds up in the real world, especially when the IRS is watching.
Okay, here is probably the system's biggest performance flaw: phantom income. It works like this. You have to pay taxes on your full allocated share of the profits, even if you never took that money out as a cash distribution. And this can create an absolute financial nightmare. You're stuck with a massive tax bill, and you have none of the cash from the business to pay it.
Now, this is really interesting. This is basically how the IRS benchmarks your performance. They look at your ratio of salary to distribution and compare it to what's normal for your industry. So, a dropshipping business? Yeah, you could probably justify a tiny salary and huge distributions. But a hands-on restaurant owner, they're going to expect to see a much higher salary compared to distributions. If your numbers look way out of line for your industry, that's a major red flag for them.
So, what are the things that actually trigger an audit? Well, here are the main culprits. The IRS uses algorithms to flag weird patterns. They check your company's K-1 forms against your personal tax return, so if those don't match up, that's an instant red flag. And even simple stuff, like using nice round numbers instead of exact figures, can make it look like you're just guessing instead of keeping good records.
So clearly, this system has some serious potential failure points. But that's only half the picture. To get a really balanced take, it's time for our scorecard, where we're going to lay out the clear-cut pros and cons of this whole setup.
Okay, on the pro side, the strengths are pretty undeniable. First up, the flexibility is just unmatched. You can reward people for what they actually contribute. Second, tax efficiency. The fact that distributions aren't hit with self-employment taxes is a massive advantage. And finally, adaptability. You can tie payouts to how the business is actually doing, which is perfect for avoiding fixed costs when things are lean. But the cons are just as significant. That flexibility we just praised, it's the very thing that creates a high audit risk. The compliance burden is huge. You need a rock-solid operating agreement and just flawless records. And, like we saw, that phantom income liability is a serious financial risk that can catch even the smartest owners completely off guard.
All right, we've unboxed it, we've gone through the features, we stress tested its performance, and we've scored the pros and cons. Now it's time for us to deliver our final verdict.
So, what's our final verdict? The multi-member LLC payout system is a high-performance machine, no doubt about it. In the hands of an expert who really understands the rules of the road, it's incredibly powerful. But for anyone who's unprepared, it's genuinely dangerous. Its greatest strength, that amazing flexibility, is also, without a doubt, its biggest risk.
So, if you're going to use this system, you absolutely need an audit-proofing checklist. Number 1, get a formal written operating agreement. It's your number 1 defense. 2, document everything, every distribution, every meeting, every decision. 3, keep your bank accounts separate. Business and personal do not mix. 4, use accurate numbers. No estimates, no rounding on your tax filings. And finally, number 5, if you're doing anything complex, like special allocations, please consult a professional. Make sure you're passing that substantial economic effect test.
And that brings us to the final question for you. We've reviewed the system, we've laid out the rules of the game, and we've shown you the risks. So now you have to look at your own business and ask, is your distribution strategy actually built to win, or is it basically just waiting to be audited? The choice is yours.